In today's video, I'm quizzing you on your financial literacy. Now, I read an article recently that said that 94% of Americans could not pass a basic financial literacy quiz. That is not good, obviously, but also not surprising. Most Americans were not taught this in school. We're not taught it at home. People just don't talk about money. It's like this taboo subject. But then not only are we not teaching our children good financial habits, we're often learning bad money habits from our parents. So what's even worse is I found that I was doing research when I was putting together this video is that we are completely out of touch with our actual financial literacy, like out of touch with reality, completely with what we know about money. Many people are overly confident in their financial literacy acumen, and they think that they know more than they actually do, a lot more than they actually do, which can be dangerous since that overconfidence can cause you to really not take the time to learn and understand very basic money concepts. So if you think like, oh, I already know everything about money there is to know, I know I'll get all the right answers, I really challenge you to stick around for today's video. Hopefully you will learn something new, and if not, at least you'll be able to say, ooh, I got 6 out of 6 right. So I pulled today's quiz. It's the FINRA Investor Education Foundation National Financial Capability Study. Terrible name, but it has just 6 questions and it's a pretty good quiz. So I'll go through each question on the quiz and then I'll share with you the right answer, and then I'll talk a little bit about why it's so important to understand the right answer and help you kind of understand why the answer is what it is. All right, let's get into it. So question number 1, suppose you have $100 in a savings account and that savings account is earning 2% per year. At the end of 5 years, how much will you have if that $100 earns 2% a year? Will you have more than $102, less than $102, or exactly $102? The correct answer is that you would have more than $102. If you are earning 2%, you're earning that per year, so it builds over time. So after year 1, you have $102, but then you're going to earn 2% on that new 102 balance. So after year 2, you'll have $104, and on it goes over that 5-year time period. Now this question, what it does is it really tests your understanding of compound interest. I call compound interest, it's the 8th wonder of the world. It's amazing, and it's absolutely essential that you understand compound interest because it can have a decimating impact on why you should not own debt. If you own a lot of debt, it's decimating, but it can generate some amazing results from you too if you have your money working for you as an investor. Compound interest works both ways. So if you're finding this video helpful so far, please hit that like button and give it a thumbs up. All right, question number 2. Imagine that the interest rate on your savings account is 1% a year. Inflation is 2% a year. Now, after 1 year, would the money in the account that earned 1% buy more than it does today, about the same as it does today, or less than it does today? Well, the correct answer is that it buys you less. And the reason why is that that inflation rate was 2%. So in the above scenario, prices grew at by 2%. Bread, gas, milk, travel, whatever, light bulbs, let's just assume it all went up together 2%. So everything is now more expensive than it was a year ago by a little bit, 2% or more. But the money that you had in your bank account, remember, it was only earning 1%. So even though you get to the end of the year, your $100 grew to $101, but that $101 does not buy you as much in terms of goods and services as it did a year ago when you just had the $100. So in reality, you lost money after accounting for inflation. Not good. Now, it is very important that you understand inflation and how it works against you, because it will ensure that you don't just invest in canned foods, gold coins, and a bunch of guns to protect yourself for the future. You must invest in things that are going to outpace the rate of inflation so that you are actually not losing money over the long term. All right, question 3. If interest rates go up, what will typically happen to bond prices? Will they rise? Will they fall? Will they stay the same? Or is there no relationship whatsoever? The correct answer is bond prices will fall if interest rates go up. There's an inverse relationship. And you can picture it like a seesaw. So if you have this seesaw, here we are, interest rates are really low right now. So interest rates are down here, bond prices are going up. But as interest rates start going up, which they actually have been over the last few months, bond prices start to go down. So with that in mind, what would happen to the value of your overall bond portfolio if interest rates go higher, especially if they continue a lot higher? Yes, the value of your bond portfolio will drop. So it's really important to pay attention to that. I would avoid bonds with longer maturities, since those are the ones that hit harder when interest rates start climbing again. These are bonds that may be mature in 10 years, 15, 20, 30 years. I would avoid those like the plague. Question number 4. A 15-year mortgage typically requires higher mortgage payments, higher monthly payments than a 30-year mortgage, but the total interest of the life of the loan will be less. Is that true? Is that false? Well, the answer is true. Even though those payments are going to be higher on that 15-year loan, it is a much better deal than the 30-year mortgage over that 15 or 30-year time period, because you will end up paying a lot less in interest. And I don't mean like $12 less in interest. I mean, depending on the size of your loan, it's usually in the tens of thousands of dollars, if not a lot higher than that, depending on how large your mortgage original loan amount was. So with the 15-year mortgage, you will be paying a lot more in principal with each and every payment. So if you think about it, like every single mortgage payment you make, a portion of that is principal repayment on your original loan value, but then the other portion of that is interest. And on a 30-year mortgage, a lot higher percentage, especially in the early years, is going to be interest, and a lot lower percentage is principal repayments. But when you have a 15-year mortgage, you have to accelerate those interest payments, and so it's more kind of balanced out, and you're paying a lot more in principal than you would if you were sticking with the 30-year mortgage like most people do. Question number 5, buying a single company stock usually provides a safer return than a stock mutual fund. Is that true or false? Well, I hope and I pray that you said that is false. A stock mutual fund is much more diversified than a single company stock. So the stock mutual fund is going to provide the safer return, since it is not tied to the fate of a single company or stock. When you buy a stock, you actually buy a percentage of ownership in that business. As a result, your results when you buy just a single company stock, you are really completely, totally hitching your wagon to the fate of that one business. So the safer and more prudent choice is to diversify across a lot of different stocks, and you can do that easily through a mutual fund or even an exchange traded fund, aka an ETF, or an index fund. Those are all great options. Most stock mutual funds and ETFs, they own anywhere from maybe 50 companies to 1,000, if not many more than 1,000. So you could just purchase one share of a mutual fund, $50, $100 investment. It doesn't take much. And if you do that, you indirectly own a tiny percentage of all the stocks that are owned by that particular mutual fund. So you get instant diversification with very little investment, and it's a great way to ensure that you are not tying yourself to the fate of any one particular business. All right, we're coming into the last question. Suppose you owe $1,000 on a loan, and the interest rate that you are charged is 20% per year, and that's compounded annually. If you didn't pay anything off at this 20% interest rate, how many years would it take for the loan amount that you have, the debt that you have, to double? Would it take less than 2 years, 2 to 4 years, 5 to 9 years, or 10 plus years? The answer is 2 to 4 years. The exact answer can be found by using the rule of 72. That's a really quick and easy way to figure out how long it will take you for your money to double. So it's used all the time when you're thinking about an investment, but flip side's also true when we're talking about debt as well. So it works in the reverse case, in the case of this question that's posed here. So what you do is you take 72, you divide it by the interest rate, so it's 20% here, and that tells you how many years it will take you for the amount owed on this particular debt to double. So 72 divided by 20 is 3.6. That means that in 3.6 years, the amount that you owe, if you don't make payments and work on knocking out that debt, that is going to double. So this is why a high interest credit card debt is so damaging, because 15, 20, 25% annually, if you are not working aggressively to pay that off, the debt is just growing and growing and growing and growing. And frankly, this is a big reason why the rich get richer and the poor get poor. There is a lot of truth to that, because people who have a lot of debt, you're digging yourself further into the hole of having a negative net worth. Whereas if you do not have debt and you're taking that money and you're investing that, even if you earn not 20%, but even if you earn like 7%, which is not like hitting home runs, you're still going to double your money. If you use that rule of 72, you're still going to double your money about every 10 years. So very important to understand compound interest and how it works for you, but also against you. Well, I hope you learned something new today. Did you learn something new? If you scored a 3 or higher on this financial literacy quiz, congratulations, because you know more about financial literacy, money, than the average American. Good job. If you got value from this video, please hit that like button. Be sure to check out my podcast as well, the 1 Minute Retirement Tip. I put links to that all in the description below. You can listen to it wherever you listen to podcasts, including your Amazon Alexa device, by subscribing to it on your flash briefing. Thank you so much for watching. My name is Ashley Michike, and I hope you have a blessed day.